welcome, guys. This is chapter 5. We are in financial accounting, the Spiceland book, and we're going to be going over chapter 5 today. So chapter 5 is dealing with the receivables. So the transactions involving sales, which would be revenues, and then we know when someone purchases an item or a service, they can pay cash up front. But quite often with large companies, they have what's called a receivable, which means in order to stay with customer standards or company standards, oftentimes they allow customers to pay within 30 days or 60 days. It's a receivable. So today we're talking about receivables and sales. So how do we go about recognizing accounts receivable? Well, when we are selling a product and service to a customer and we give it to them, we transfer that over to them, and they don't pay us at that time, but the company expects to collect cash in the future. We can call these credit sales, or they can be called sales on account or services on account. Remember, this is accounts receivable. When the company owes money and we haven't paid it, that's accounts payable. Payable is a liability when the company owes money to somebody. Accounts receivable is when customers owe money to the company. So the company is due to receive money. Credit sales are common for many business transactions. So an accounts receivable, remember, is cash owed to the company by its customers from sale of either goods or services. We record at the time of the sale or the services that accounts receivable. We would record an accounts receivable along with a credit to sales revenue. So here's an example. An example could be Link's dental charge $500 for teeth whitening. DK decides to have her teeth whitened on March 1st, but doesn't pay cash at the time of her service. But she promises to pay the $500 whitening fee to Link by March 31st. So what would we do here? We would show a debit to accounts receivable for $500, and we would show a credit to service revenue for $500. This is once the job is completed, we have provided the service, we would record this transaction. Companies record an asset, which is the accounts receivable, and we would credit the revenue when they sell products or services to their customers on account, expecting payment in the future. Now, there may be other types of receivables that companies record. Tax refund claims, interest receivable, loans by the company to other entities, and that means the company lends money to others So it would be a notes receivable for the company. Notes receivable are formal credit arrangements evidenced by a written debt instrument. So what that means is a note receivable is a legal document where it is stated so-and-so owes so-and-so, and they have an interest rate attached. Hey guys, now I would like, since there's 10 of you, I should see 10 answers in the chat box. Which of the following are sometimes called trade receivables? Would they be accounts receivable, interest receivable, note receivable, or tax refund payment? So all of you have said A. Awesome, guys. Now, oftentimes we have various caveats to selling an item. And basically, what we have is based on particular situations, we can offer a reduction in the price of a product or service. Now, we do this to provide various incentives in people using us, or sometimes offering discounts if they pay in time. So the trade discount in this example is where there's a reduction in the list price, using this to provide incentives to larger customers, maybe larger companies or certain consumer groups. So in this scenario, Lynx Dental says, hey, we normally charge $500 for teeth whitening, but this month we're offering a 20% discount. So basically what we're doing is just charging less for a service. When this occurs, we don't show the trade discount. We just show that the price is 20% less, or instead of 500, it is 400. So in the case of a trade discount, we would debit our accounts receivable for 400, and we would credit our service revenue for 400. Now, another type of discount called sales returns and allowances. This is when a customer already has purchased the product and they're not happy with it. So when a sales return or allowance happens, we will always record this. When a customer returns a product, we're going to just create the journal entry and offset what we previously did. So if the seller provided cash, then we're going to refund cash. If the seller reduces the balance of accounts receivable, if the original sale was on an account. So we're going to create the journal entry exactly the way in which it was paid. If it's cash, we're going to return cash. If it's an accounts receivable, we will offset that accounts receivable. However, sometimes companies customers don't necessarily return the goods. We will sometimes reduce the balance of the accounts receivable. Or if they don't necessarily return the goods. We may give them back some cash. Here's an example. After getting her teeth whitened, I know I spelled that wrong, whited, I meant whitened on March 1st, Dee notifies Dr. Link on March 5th that another dentist is offering the same procedure for $350. So in this case, since this is a sales allowance, Dr. Link is going to record a journal entry reducing the account balance by $50. And he will use the account sales allowances for $50 and credit the accounts receivable for $50. So this is recorded. This is after the fact. She realizes she could have gotten it cheaper. Then on the books of Dr. Link, they will debit a sales allowance and credit accounts receivable. Now know that this sales allowance is considered a contra revenue account. It will be reported against total revenues in the income statement, but with a negative balance. Think of it like assets and then accumulated depreciation. That's a contra account against an asset. In this case, this is a contra revenue account. Remember, guys, students sometimes misclassify contra revenue accounts. The sales returns and sales allowances are sometimes misclassified as an expense because it's a debit, but no, guys, it's not an expense. It has a normal debit balance, and it ultimately reduces the amount of net income. But the contra revenue represents reductions in revenues, whereas expenses represent the separate costs of generating revenues. Okay. Now, a sales discount is where we offer a customer a reduction if payment is made within a specified period of time. So Lynx Dental says to Dee, hey, Dee, if you pay within 10 days, we'll give you a 2% discount, 210 net 30. That means a 2% discount within 10 days. Otherwise, you pay the full balance within 30 days of the $350 owed. D pays on March 10th, which is within the 10 days. So what we're going to do is we will debit the cash of what she paid, $343. We will debit the sales discount of $7, the 2% of the amount she owed, and we credit the accounts receivable for the entire $350, which clears out her receivable account. Sales discounts are also a contra revenue account. These will be offset against our sales. We report with total revenues in the income statement, but this sales discount will have a negative balance. So you see here, the sales revenue shows $400. The less sales allowance of $50 and less sales discounts of $77 gives us a net service revenue of $343. That makes sense, guys? So the balance of the accounts receivable after the credit sale and subsequent collection on account It started with 400. We credited the accounts receivable with the sales allowance of 50 and the sales discount of 7 to give an ending balance of 0. How about this one, guys? The effect of a sales allowance will result in which of the following? A, an increase to net income. B, a decrease to net income. C, an increase to accounts receivable. Or D, an increase to sales revenue. Two more people need to input. It would be a decrease to net income. And guys, again, which of the total computations would be used to compute net revenue? What would we show? A, B, C, or D? Total revenue minus the sales discount minus the sales allowance. Okay, so now we see on the income statement, we will show our sales revenues. We will subtract any discounts, any returns, and any allowances to come up with our net revenue. So now, guys, what I'd like to do is go into our homework, and we are going to complete the first 2 problems of our homework this week. So I think it will be helpful to do this together. And if you do not get the answers, you can always go back to the recording that I always post and review this. So I won't be doing it at the end here as we're doing it now. So guys, here is data recovery services. They specialize in data recovery from crashed hard drives. The price charged varies based on the extent of damage and amount of data being recovered. DRS offers a 20% discount to students and faculty at educational institutions. Consider the following transactions during the month of June. So what we're going to do is we're going to record the necessary transactions on each date. The first transaction on June 10th says Rashid's hard drive crashes and he sends it to DRS. What kind of journal entry would we record here? Did an economic event occur? No. Rashid just sent it to DRS. There is no journal entry here. So you can see no journal entry is required. Okay. Next, after an initial evaluation, DRS emails Rashid to let him know that full data recovery will cost $2,600. Hey guys, did an economic event occur? No. We're just informing him if they in fact would do the service, here's what it's going to cost. Then Rashid informs DRS that he would like them to recover the data and that he is a student of UCLA, qualifying him for a 20% educational discount and reducing the cost by $520. 2,600 times 20%. Did an economic event occur? No. He's willing, he wants them to do the service, but they haven't done the service yet. Now, number 4. DRS performs the work and claims to be successful in recovering all data. DRS asks Rashid to pay within 30 days of today's date, offering a 3% discount for payment within 10 days. So we are going to record this journal entry. The service has been done. We know Rashid gets the 20% discount. And the 20%, let me just confirm, 20% discount is on 2,600. So we are at this time going to show an accounts receivable or 1615, right? 1615, is it a 30% discount? 20%. 2,600 times 20% is, oh, let's see. Am I doing this right? 2,600 times 20% discount. I want to make sure I'm doing this right. 2,600 times 80% is what we would show. Do I have different numbers here? Okay, I've got different numbers. So are you seeing that this would be 2,080 based on this one here? Right, guys? 2,080. Right? And we would show a service revenue of 2,080. Make sure my work is right. You got it. Okay. So moving on. We would record a journal entry on that event. Then it says, DRS performs the work and claims to be successful in covering. That's the one I wrote on June 16th. Then on June 19th, when Rashid receives the hard drive, he notices that DRS did not successfully recover all data. Approximately 25% of the data has not been recovered. So that is just an informational event. There was no let's go up back here. There was no journal entry being required here. Okay. Then, because DRS realized they kind of goofed up, they are going to reduce the amount Rashid owes by 25%. So in this case, he is supposed to pay 2,060. Let me just make sure I've got the information right. 2,080. And so the 25% of 2,080, sorry about this messy. Let me just clear this, clear contents. So 2,080, 2,080 times 25% means this would be a $520 reduction. So this journal entry, guys, would be sales allowances. Did I say 520? Can't even remember what I say. 520. And we are going to credit the accounts receivable because he no longer owes that amount anymore. Right? Then Rashid pays the amount owed. So he owes the accounts receivable started at 2,080. And then we did a credit of 520. So the amount now he should owe is 1,560. So we would have cash of 1,560. And we would credit accounts receivable of 1,560. Let's make sure I did it right. Yep. Any questions, guys? Does this make sense? How's everyone doing? Okay. Now, the next one, show how revenues should be presented in the income statement. Well, our total service revenues should be 2,080. $2,080. And then we would have less sales allowances of, did I say 540? 20. And it would give us our net service revenue here, 2,080 minus our 520 or our 1,560. Okay. That makes sense, guys? Okie doke. Let's go back to our PowerPoint now. Now we're going to spend some time talking about the valuation of accounts receivable. We recognize accounts receivable as assets in the balance sheet, and we report them at their net realizable value. That isn't the amount we're due, the accounts receivable we're due. It's the amount we expect to collect. Now, what does all that mean? Some of these accounts receivable aren't going to be collected. Let's just face it, not everyone's going to pay. Companies are required to estimate the future uncollectible accounts, and we record that estimate in the current year. That estimated uncollectible account reduces our asset, which is accounts receivable, and also will increase our expense, which we call a bad debt expense. Under this method, companies are required to estimate what we're not going to collect in the future, and yet record those estimates in the current year. Estimated uncollectible accounts will reduce our assets and increase our expenses. So guys, think about it. One thing we know is we offset our revenues with the expenses they help to generate. Well, if in today's year, in this year, we show revenues of a certain amount, and yet we know we're not going to collect them all, we have to record that bad debt expense in the period in the revenues they help to generate, which is why we have to create a reserve basically for uncollectible accounts. Now, there's a couple ways we can do it. We can do it by a percentage of receivables method, which bases the estimate of bad debts on a balance sheet amount, which we call accounts receivable. We can call it the balance sheet method. So in doing this, we estimate, the way we are estimating these uncollectibles is at the end of the year, Kimsey's owed $20 million from customers and estimates that 30% will not be collected. So what we would do is we would debit a bad debt expense, which we know it's an expense, bad debt expense, 30% of 20 million, 6 million. And we credit this Contra account called allowance for uncollectible accounts of 6 million. Now this allowance will offset the asset accounts receivable. Okay, so it estimates our future bad debt expense. We know the bad debt expense is listed in the income statement as an expense, and the allowance for uncollectible accounts is going to be a contra asset reported with an offset against accounts receivable in the asset section of the balance sheet. Okay. This shows the income statement, how we have our sales and we show our bad debt expense. Now, let's think about this, guys. In a timeline in 18, which is the current year, we have credit sales of 50 million. At the end of the year, we've still not collected 20 million of it. So that's an accounts receivable sitting in the balance sheet. We estimate what percent of that's not going to be collectible, which is the 6 million, which ends up showing us our net receivable of 14 million. Adjusting for estimates of future uncollectible accounts matches the expenses in the same period as the revenues they help to generate. So when we record an allowance for uncollectible accounts correctly, it reports accounts receivable at their net realizable value. Now, guys, because allowance for uncollectible accounts has a normal credit balance, students sometimes misclassify this account as a liability, which also has a normal credit balance. But remember, this isn't a liability. This is a contra asset account representing a reduction in the related asset account. Okay? Does that make sense? Okay. Now, who wants to take this one? Which of the following is true regarding allowance for uncollectible accounts? It is a liability account. It is added to the total of sales discounts, sales returns, and sales allowances. It is subtracted from the balance of accounts receivable in the balance sheet. Or it appears in the income statement as an expense. It is subtracted from the balance of accounts receivable in the balance sheet. Okay, so let's look at another problem. Okay, let's go to this problem 4 here. The following events occur for Morris Engineering during 2021 and 22. Its first 2 years of operations. On February 2nd, Morris provides services to customers on account for $37,400. Can anyone say what we're going to record here on the journal entries? We know it's $37,400, but what are we going to record? What accounts are we going to use? Anyone?
Account receivable and service revenue.
Awesome. Yes. Accounts receivable. And we're going to record service revenue of $37,400. Okay. Excellent. Now it tells us we received, and you know what I'm going to do, guys, just to have it, I'm going to put this in here. 37,400. This is, I'm going to show an accounts receivable. Okay, so 37,400 is our accounts receivable. Now it says we received 26,500 from customers on account. We know we're going to debit our cash of 26,500. 26,500. What are we going to credit, guys? Any ideas?
Account receivable.
Yes. Accounts receivable for 26,500. Okay. Awesome. Now it tells us estimate that 30% of uncollectible accounts will not be recovered. So what we're saying here is 30% of this difference. So 30% of the 37,400 30% of 10,900 is not going to be collected. what would 30% of 10,009 be? Wouldn't it be 3,270? So 3,270, guys, we would put in here bad debt expense of 3,270, and our offset is allowance for uncollectible accounts of 3,270. Remember, this is a contra account to our accounts receivable. Let's just make sure I did it right, because I don't want to lead you astray. Okay? Got it? We record that. Now it says in the next year, we provide services to customers on account of 50,400. So we're going to show an accounts receivable of 50,400. And we show service revenue. Oh, I'm sorry, I don't know why I popped down there. Service revenue of 50,400. Okay. I'm going to add that to here. Okay. Are you guys following me so far? Then it says we received $6,000 from customers for services provided in 2021. So in that case, we're going to show cash of 6,000, accounts receivable of 6,000, right? And our allowance, I just got to go back and remember what I showed there. Our allowance for uncollectibles was 3,270. So I had 3,270 sitting here. Okay. So basically, what we have collected in the for 2021 we're missing 4,900 of it, aren't we? We collected the accounts receivable was 37,400. We collected 26,500 and we collected 6,000. So we've got 4,900 outstanding there. Okay. Now it says write off the remaining amounts owed from services provided in 2021. So what they're telling us is we're not going to collect that money anymore. Let's go ahead and write it off. So what that means is in 2021, we showed receivables of 37,400. We collected in 2021, 26,500. And in 2022, we collected 6,000 from the sales in 2021. So the 37,400 minus the 26,500 minus the 6,000 means 4,900 we need to write off. So we are going to debit allowance for uncollectible accounts of 4,900. And we are going to credit accounts receivable for 4,900. Let me make sure I have it correct because I don't want to. Well, that's 4,900. No journal entry required. So this, I didn't need to say no journal entry required. I meant to say accounts receivable. My goodness. Look at me. I swear I did that. Okay.
Professor,
Now.
I have a question.
Yes.
So the 50,000 that you also got an account for services, that's not involved in the calculation for
Not
the,
yet. Not
oh,
yet. Because we were just writing off from the previous year. So basically what we were doing here, this was 2021. This was the cash we received in 2021. And here was the additional cash we received in 2022 for 2021. So all we're doing in this particular situation is writing off what we know we're not going to receive of the 2021 sales. Now we're going to start talking about 2022. Remember, the purpose here is writing off the bad debts of what we're not going to receive. So the reality is sales continue to happen, but we're specifically breaking down because it tells us in our example, it will say, we provide, we received 26,000 from customers on account. Then it said, we received 6,000 from customers for services provided in 2021. Now this next one will deal with 2022. So we did just write off the remaining, but now in number 7 says, receive 44,500 from customers for services provided in 2022. Here's when we will debit our cash. Of 44,500. Here's where we will credit our accounts receivable for 44,500. And I'm going to show this. Now I'm going to show, this is 2022. Here's 2022. Did I say 44,500? 44,500. We received cash, 44,500. Okay. And there's one journal entry I didn't put in that I need to. It was when we wrote off the rest of the bad debt. I thought that was equals 37,400 minus 26,500 minus 6. We wrote off 4,900. Remember how this 4,900 was a debit to allowance for uncollectible? And we credited accounts receivable for 4,900. So now I want to get rid of that. No border. I want to now down here show our new balance. So our new balance is going to be the 50,400 minus our 44.5. We should have a new balance now of 5,900 sitting in our accounts receivable. Now it says, estimate that 30% of the uncollected accounts will not be received. So 30% of the 5,900 will not be received. What would that be? %30 of 5,900. $1,770. It's here we will say allowance for uncollectibles. Excuse me, I'm wrong. Bad debt expense of 1,770. And we credit our allowance for uncollectibles of 1,770. And hopefully I'm right here. What did I do wrong? Bad debt expense of allowance for uncollectibles. Oh, I know what I did wrong. 1,770. So what I did wrong here is I've got to adjust for what's still sitting in this allowance for uncollectibles right here. So I probably need to take this accounts receivable of 5,900 times the percent they said, 1,770. Plus I need to see where my balance is here in my uncollectibles. You see, this should normally be a credit balance, but here we've got the allowance minus this uncollectible. We've got 1,630 sitting as a balance here in this allowance for uncollectibles. This should normally have a credit balance. So we're going to need to add the 1,770 plus this 1,630 or 3,400 to, here, let me return to question, 3,400. Let me just confirm it. I don't want to lead y'all astray. I might have gotten ahead of myself from the where we were in the PowerPoint. Yeah, 3,400. So what happened, guys, in this scenario is we want this new number over here to be 1,770. We need our allowance for uncollectibles to show 1,770. So what is it we need to record to make this new number 1,770? Because we were sitting with a debit balance in uncollectibles of 1,630 from the year before, And we need this to say 1770. We need to show this as 3,400 in order to make our ending balance. Here, let me just 1770. So in other words, our allowance for uncollectibles ending balance needs to be 1770. 30% of this 5,900. Because we had 3,270, a debit of 4,900, this becomes our plug-in figure. So we can end up with 1770. So we're constantly going to be adjusting this bad debt expense. Since the year before, we underestimated our bad debts. This year, we need to catch up for what actually did occur. So this figure here would need to be, sorry, the 3,400. So let me go back and see if I'm just going to finish this portion so you understand what I'm doing. So what they want us to do is they want us to post these transactions to the cash account, the accounts receivable, and the allowance for uncollectible accounts. So we are going to provide services for customers on account 37.4. So we're going to show that transaction. Actually, I'm going to show number. Well, if I do that, it's going to change. So what we need to do is go and show provide services to customers on account February 2nd. We're going to show the 37,400. Then it tells us on July 23rd, we received 26,500 from customers. We received 26,500 from customers. Then on December 31st, we estimate that 30% of the uncollectible accounts will not be received. So on that one, we showed 30% of the uncollectible accounts will not be received. So I have that written down somewhere. 3,270 will not be received. Okay, so we're going to show on this date, December 31st, 3,270 will not be received. Okay. Then it told us provide services to customers on account on April 12th of 2022. We provide services to customers on account for 50,400. Then it said on June 28th, we received 6,000 from customers for services provided in 2021. Then it says write off the remaining amounts owed from services provided in 2021. So what we'll need to do is take the 37,400 minus our 26,500 minus our 6,000, and we're going to need to write off that amount, which was 4,900. So what we'll do is we will debit, let me make sure, on September 13th, we are going to write off, shoot, I just forgot what I said, 4,900. We're going to write off our 4,900. We're going to write off September 13th, our 4,900. Okay. Then it says we received 44,500 for customers provided in 2022. That's October 5th. $44,500. Okay. And we will show that October 5th, we received 44,500. Now it says we need to estimate that 30% of the uncollectible accounts will not be received. 30% of 5,900, 30% of that equals 30% of 5,900 is 1,770. So that is what this new allowance needs to be. This new allowance for uncollectibles needs to be 1,770. So in order to make this balance 1,770, we need to show on December 31st, since we need this number to be 1,770, we'll need to write off whatever we can do to make this 1,770. So our 1,630 plus our 1,770 is 3,440. Nope, I didn't do that right. 3,400. Do you see, to make 1,770 as our balance, we would need to debit our bad debt expense for 3,400. That second year is a catch-up year because the balance for the allowance means that's what we need this balance to show. So we need to plug this figure in. Okay, let me just make sure I have everything I need here before I move on. Okay. So maybe I got a little ahead of myself, but I'm trying to help you see how we work through the problems. Okay, let's go to here. When we use the aging method to estimate future cash flows, what we do is we look at our accounts receivable and see how old they are. Do you see 10% are not yet due? 30% of what is uncollectible is between 1 and 60 days old. 50% of our uncollectibles are between 61 and 120 days old. And 70% or excuse me, it's not the percent. This amount of $1 million is not yet due. 1,800,000 is 1 to 60 days old. 61 to 20 days old is 1.5. And then more than 120 days old is 700,000. Based on past experiences, the company says, okay, we know the older the outstanding portion is, the less chances are we're going to collect this money. So they, based on history, say 70% of these receivables that are over 120 days old, chances are we're only going to collect 30%. We're not going to collect 70%. Those that are 61 to 120 days old, our history says 50% of these aren't going to be collected. Based on those that are between 1 and 60 days old, 30% aren't going to be collected. And those that aren't even yet due, we still know we're not going to get everything. So we're going to say 10%. So what this method does is it, based on their history, they've come up with a formula. And you see this formula increases with the age of the receivable. As they get older, it's going to be harder to collect. So they take this schedule and they determine their amounts uncollectible based on the schedule, which probably is a lot more accurate than just taking a flat percent of receivables. So this is a method many companies will use to figure out what amount of their receivables will not be collected. So in this case, I'm sorry, here are the receivables here. They multiply it times their percentages they've come up with to figure out what is going to be uncollectible. The reason this is beneficial, it considers the age of the receivables, and it's usually going to be more accurate than just a single percentage. So from Kinsey's aging schedule, the estimate of uncollectible accounts equals 5 million, which is going to be a debit to bad debt expense and a credit to the allowance for uncollectible amounts. Guys, which of the following is true about the aging method? A, no estimate for uncollectible accounts is made. B, older accounts are more likely to be connected. C, it's not acceptable for GAAP. Or is it D, older accounts are less likely to be collected? What do you think? I hope y'all think it's D. The aging method recognizes that the longer accounts are past due, the less likely they're going to be collected. The aging method should provide a more accurate estimate of total uncollectible accounts. Okay? That makes sense. So let's talk in more detail about how to write off accounts receivable as uncollectible. When it's obvious the customer is not going to pay, the company writes off the customer's account balance as uncollectible. When we do this, the write-off reduces the balance of accounts receivable, and it reduces the balance of the allowance for the uncollectible amounts. Ultimately, it has no effect on total assets, since we have that allowance available to us It's just taking from one, the Contra account, and writing it off to the accounts receivable. Since that negative effect of bad debts has already occurred, we just have that ability to use that allowance method. So if you see here, Kimsey receives notice, excuse me one sec. Jim, do you want me to go in the other room? Okay. Kimsey receives notice that Bruce Easley has filed for bankruptcy and will not pay the $4,000. Kimsey writes off Bruce's accounts receivable. Now he does that by debiting the allowance for the uncollectible accounts and crediting his particular account. So that his particular account's zeroed out, and we offset it by debiting that allowance for uncollectibles. The write-off decreases the Contra account and it decreases the asset. But guys, ultimately the net effect is zero. We made it happen when we determined how much we needed to allocate for the allowance. And that's when we did our debit to bad debt expense, our credit to the allowance for uncollectible account. That's when we made the adjustment. When we actually write off an account, it's not going to affect our balance sheet at all. Students think that recording a bad debt expense, that they're going to record a bad debt expense when they write off an uncollectible account. But that's not the case. That bad debt expense was already recorded in the year in which those sales happened, at the time we estimated those uncollectible accounts. So now Bruce, we wrote off his account. All of a sudden he has decided he's going to pay 25% of the amount owed. He's paying us $1,000. Guys, we already wrote off his account. So if something like this happens, we have to reinstate the $1,000 he's going to write off. So we debit his accounts receivable, credit the allowance, and then we take our debit the cash piece it gave us and credit his accounts receivable. That's what we do if someone later comes back and pays. When we write off an uncollectible account, A, bad debt expense is debited, net income is decreased, total assets are unchanged, or the allowance account is credited. Let me see what you guys are coming up with. Awesome, guys. You're correct. The assets are unchanged because remember, we're just debiting the allowance and crediting the accounts receivable. It's not going to affect assets. Remember, writing off a customer's account as uncollectible reduces the balance of accounts receivable, but also reduces the contra asset, allowance for uncollectible accounts. The net effect is that there is no change in the net receivable, the accounts receivable less the allowance, or in total assets. We recorded the decrease to assets as a result of the bad debt when we established the allowance for uncollectible accounts in a prior year. Now, remember when we talked about this aging method, Kimsey's estimated bad debts was $5 million. But guys, the actual bad debts were really only $4 million, which means we overestimated the bad debts by $1 million. I mean, guys, it's an estimate. We don't know. We're doing the best we can. So the estimate is just purely an estimate. But in this case, we overdid it by $1 million. But guys, look what happens. In the next year, when we estimate bad debt expense to be $8 million, how does Kimsey record its $8 million of estimates? What we do, guys, is we will offset the difference. Just like when we worked on a problem, we had understated our bad debt expense the previous year. In this example, we overestimated the bad debt expense in the previous year. So when we estimate in the next year for the bad debts to be $8 million, we will adjust it to show the bad debt expense is only $7 million. Because again, since we overdid it in the first year, we'll fix it in the next year. Remember, when we estimate the bad debts to be $8 million, that's what we want the balance to be in the allowance for uncollectible accounts. So to make that balance happen, we have to plug in the year-end adjustment. And that year-end adjustment will be based on what's happened in the previous year. In this case, if we overstated our bad debts, then this number will be less. It's only going to be $7 million. If we understated our bad debts, then our adjustment's going to be greater because we need to play a catch up. The key to remember is estimating our allowance for uncollectible amounts means this is what we need the balance to be. And it's a plug-in to how we get there. The bad debt expense in the income statement will be the $7 million. But the portion in the balance sheet is going to be the balance of the allowance for uncollectible amounts. What if actual bad debts in 2019 were $6 million compared to an estimate of $5 million? Do you see how we understated it that year? And then if we estimated bad debts in 2020 to be $8 million, we will have to show the bad debt expense to be $9 million in order to come up with the balance here of $8 million. When an entry is made to write off an uncollectible account, A, is bad debt expense debited? B, is net income decreased? C, are total accounts receivable unchanged? Or D, is the allowance account credited? What do you guys think? Agbecto, you are amazing. You are right on. Great job, guys. Now, let's go and work on some problems. Sometimes this is the best way to learn, is to just do problem after problem. Guys, sorry about that. I have a worker at my house. Okay. Let's look here. Lutney Corporation engages in the manufacture and sale of semiconductor chips for the computing and communications industry. During the past year, operating revenues remained relatively flat compared to the prior year, but management notices a big increase in accounts receivable. The increase in receivables is largely due to the recent economic slowdown in the computing and telecommunications industries. Many of the company's customers are having financial difficulty, lengthening the period of time it takes to collect on accounts below our year-end accounts. Paul, the CEO of Lenti, notices that accounts written off over the past 3 years have been minimal, and therefore suggests that no allowance for uncollectible accounts should be established in the current year. Any account proving uncollectible can be charged to next year's financial statements, the direct write-off method, which we'll talk about. Do you think Paul's reasoning is right? I mean, do you see the average days here? 2 years ago was 5 days, then 7 days. In this current year, it's 40 days. Is there a problem? You think there's a problem, guys? I think there's a problem. Do you agree? Well, I do not agree with Paul's reasoning. No, I don't agree. He needs to come up with an allowance. Okay. Suppose that other companies in this industry have had similar increasing trends in accounts receivable aging. These companies also had very successful collections in the past, but now estimate uncollectible accounts to be 15% because of the significant downturn in the industry. If Lutney uses the allowance method estimated at 15% of accounts receivable, what should be the balance of allowance for uncollectible accounts at the end of the current year? How much would they say? 15% of accounts receivable.
Professor, would you have to minus the account written off from the account receivable, or?
Yes.
Okay.
Yes. So my take on this should be the 1,600 and 325. Let me try to get in here. 325,000 times 15% is 48,750. Plus the $1,000, 49,750. Let's see if I'm right or wrong. Okay, what? My answer is not completely correct. What am I doing wrong? What problem am I at? 8. What am I doing wrong? I'm wrong. I guess in the past, he never did. No, we don't have to do it. And the reason we don't have to do it is because he hadn't done it in the past. He just directly wrote them off. So since he directly wrote off that 1,000, we don't need to account for that. I'm sorry about that. He would have to take that into account if he was using the allowance method in previous years. But it looks like he never did use it. Because notice the accounts written off. He never had to use it before because they were so minimal. So we would just start this year taking 15% of the accounts receivable, or 325,000. But you are right that if in the past, we would have to adjust those balances. This says he never had done it before. Okay, so guys, here, based on your answer in part 2, for what amount will total assets and expenses be misstated in the current year if he uses the direct write-off method? So if he decides, I'm not going to estimate bad debt expense, I'm just going to use the direct write-off method, then how much would the assets and expenses be misstated in this current year? Wouldn't it be the same amount as the previous one we just did? Because that 48,750, guys, the 48,750 would show a debit to bad debt expense, and it would show a credit to the allowance of uncollectible accounts. If he doesn't do that, then our income statement, our net income is 48,750 higher than it should be. And our asset accounts receivable would be 48,750 higher than it should be also. Because remember, making this adjustment debits bad debt expense, which is a part of the income statement, credits your allowance for uncollectibles, which is a balance sheet contra account. Okay, now Wanda B. Rich is the CEO of Outlet Flooring, a discount provider of carpet, tile, wood, and laminate flooring. At the end of the year, the company's accountant provides Wanda with the following information before adjustment. It shows the accounts receivable. It shows estimate percentage uncollectible is 2%. It shows us the allowance for the uncollectible accounts has a credit balance of 96,000. And then we have operating income of 2,200,000. Wanda has significant stock ownership in the company and therefore would like to keep the stock price high. Analysts on Wall Street expect the company to have operating income of 1,640,000. The fact that operating income is well above this amount will make investors happy and help maintain a high stock price. Meeting analysts' expectations will also help Wanda keep her job. Our job is to record the adjustment for uncollectible accounts using the accountant's estimate of 2% of accounts receivable. So guys, I want you to take a couple minutes and I want you to decide, how do we determine, how do we create the journal entry that shows if accounts receivable is 9,600,000 and 2% will be uncollectible? What are we going to record? How do we record the adjustment to show the bad debt expense and the allowance for uncollectibles? I want you to take a couple minutes and think about it, remembering, guys, that balance showing allowance for uncollectible accounts of 96,000 matters. Take a minute and then we'll work it together. Okay. So let's look at this. The accounts receivable is 9,600,000. So let's just kind of clean this up. Let me. Here are the contents. So the accounts receivable is 9,600,000. The credit in the allowance for uncollectibles is 96,000. They want the allowance for uncollectibles to be 2% of the 9,600,000, or they want it to be 192,000. Since we have a credit balance of 96,000 sitting in our allowance, we are going to debit our bad debt expense and credit our allowance for uncollectible accounts to be the difference. Whoopsie. Sorry, I screwed that up. Equal 2% of this. So the journal entry we need to make is this minus our credit balance for 96,000 for a bad debt expense and 96,000 to our allowance for uncollectibles. So we would show bad debt expense, 96,000, and allowance for uncollectibles of 96,000. Does that make sense, guys? Is it clicking with you? Okay. Let's look at number 14 here. By the end of its first year of operations, Previtz Corporation has credit sales of 610,000 and accounts receivable of 210,000. Given it's the first year of operations, Previtz management is unsure about how much allowance for uncollectible accounts it should establish. One of the company's competitors, which has been in the same industry for an extended period, estimates uncollectible accounts to be 3% of ending accounts receivable. So Previtz decides to use that same amount. However, actual write-offs in the following year were 15% of the 210,000. Previtt's inexperience in the industry led to making sales to high credit risk customers. Record the adjustment for uncollectible accounts at the end of the first year of operations using the 3% estimate of accounts. So I want you guys to try that, see where you get. Wouldn't you take 3% of 210,000 to show as a bad debt expense? Or $6,300? This was the first year of operations, right? But problem was the actual write-offs were 15%. So by the end of the second year, Previtz has the benefit of hindsight to know what estimates of uncollectible accounts in the first year that they were too low. By how much did Previtz underestimate uncollectible accounts in the first year? And how did this underestimation affect the reported amounts of total assets and expenses at the end of the first year. So guys, if we recorded 6,300 as a bad debt expense, and yet it really was 15%. So the 210,000 times 15%, we recorded 6,300, but the real loss was 31,500. So wouldn't we show that the effect of what we showed versus what should have been showed was a difference in net income of 25,200 and a difference in assets of 25,200? So how did this at the first year, into the first year? The total expenses were underestimated. Let me just see what they want here. They were underestimated, or at the first year, they were overestimated by 25,200. And the total expenses were underestimated by 25,200. How am I coming up with that figure? I'm coming up with it because we only took 3%, when in fact 15% was the actual bad debt. So our assets were overestimated in the first year, and our expenses should have shown more bad debt expense than what they did. Okay. Okay, let's go back to our PowerPoint. Now we're going to talk about the direct write-off method, which is not GAAP acceptable. This is when you write off bad debts only when they actually become uncollectible. This is really easy to do. Unfortunately, it's not GAAP. So uncollectible accounts under the direct write-off method aren't material at all. And so when you do the direct write-off method, you literally just take a bad debt expense when you write off the account. There is no estimate that's needed. So under the allowance method, we estimate it. But under the direct write-off method, you don't estimate anything. Under the actual direct write-off method, you will show the bad debt expense and you would credit the accounts receivable. The allowance account is credited for the estimate and debited for the actual write-off when we, under that allowance method, when we actually write off an account. But under the direct write-off method, we debit our bad debt expense and we credit our accounts receivable. It's pretty straightforward. Some students think firms should reduce total assets and record bad debt expense at the time the bad debt actually occurs. But remember, when we do the allowance method, it doesn't work that way. We anticipate our future bad debts and we establish an allowance for those estimates. Know, guys, that the direct write-off method reduces accounts receivable and records a bad debt expense at the time the accounts receivable proves uncollectible. If the credit sale occurs in a prior reporting period, then the bad debt expense is not properly matched with revenues. Accounts receivable would then be overstated in the prior period. The direct write-off method is generally not acceptable for financial reporting. Hey guys, look at this one. On December 31st, before adjusting entries, a company's balance of allowance for uncollectible accounts is a credit of $2,000. What does a credit balance prior to adjusting entries indicate? A, the company did not estimate bad debts last year. B, last year's estimate of bad debts was too low. C, the company's estimate equals bad debts, actual bad debts. Or D, last year's estimate of bad debts was too high. What do you guys think? Exactly. It was too high. That's why there's still a credit balance in there. How about this one, guys? On December 31st, before adjusting entries, the company reports the following balances. We have an accounts receivable of 100,000, an allowance for uncollectible accounts of 2,000 credit. The company estimates bad debts to be 20% of accounts receivable. The adjusting entry would include A, a debit to bad debt expense of 18, B, a credit to allowance for uncollectible accounts for 24,000, C, a credit to allowance for uncollectible accounts of 22,000, a D, a debit to bad debt expense for 20,000. What do you guys think? What do you think? I'll be right back. I'm gonna run and get a water. Hey, how many of you guys got that? Awesome. Hey, since we have a 2,000 credit, we will then record the bad debt expense of 18,000. Now, notes receivable are usually formal arrangements. And it's usually shown by an agreement or a promissory note. And it has on there the date, the amount, the interest rate, the individuals on the note. And basically, with a note receivable, we need to make sure we record the interest. So when Kinsey provided a $10,000 of service to Justin, who couldn't pay immediately. Justin Payne signs a promissory note offering to pay $10,000 plus 12% interest in 6 months. So on February 1st, when this note was taken out, we will debit our notes receivable for $10,000, and we credit the service revenue for $10,000. We don't record any interest at that time because we haven't earned any interest. Okay. Notes receivable are similar to accounts receivable, except that notes receivable are formal credit arrangements. Now, after 6 months, Kimsey collects the full amount owed by Justin, including interest. The way we calculate the interest is the interest rate is always stated in annual terms, an annual interest rate. Therefore, we have to break it down by the month. So a $10,000 face amount times a 12% annual interest rate times half the year is $600 of interest. So in this scenario, when the loan is collected along with the interest, we would receive cash of $10,600. The note receivable is $10,000. And we have interest revenue of $600. When we calculate interest, we show the note was issued November 1st. At the end of 2018, we would record at the end of the period the interest receivable. Then, when the note is due on May 1st, those 4 months of interest would be interest revenue. So at the end of 2018, we would need to record interest receivable and a credit to interest revenue to report that revenue in the current period that it was earned. So then in 19, we collect 4 months of interest. So our journal entry, as you see, we would show our interest receivable of $200 at the end of the year, but we would record that revenue for that year. Then when we finally receive the money and the notice due, we debit our cash for the entire amount. We credit our note receivable for $10,000. We credit our interest receivable from the year before, and we would record our interest revenue for all of 2019. Does that make sense? The company accepts a note receivable of $5,000 on September 1st, 2018 that matures in 10 months and a stated interest of 6%. What amount of interest revenue will the company record in 2018 and 2019? I want you guys to take a minute and do this. So how we would handle that, on September 1st, a note receivable was taken out that matures in 10 months. But in 2018, we have to record 4 months of it. And then in 2019, we would record 6 months of it. So 4 months would be $100. 6 months would be $150. Okay, then the last bit is looking at ratios, which I'm going to let you do on your own. Make sure you go through some of this because you will have ratios, a homework problem with ratios, and you will have a quiz question regarding ratios. So definitely something you want to understand there. One of the last things we'll look at is another way of looking at uncollectibles is the percentage of credit sales method. We call this the income statement method. So basically, if by the end of 19, Kinsey has accounts receivable of 30 million, an allowance of uncollectibles and 1 million credit, and then credit sales of 80 million. Using the percent of credit sales method, we would estimate 12.5% of credit sales to be uncollectible. Using the percentage of receivables method, then we estimate 8 million of ending accounts receivable to be uncollectible. Now, doing it in either way, we know when we do the percentage of receivables method, we do an adjustment because we had a credit balance. Therefore, we only show the bad debt expense of 7 million. But when we do a percentage of credit sales, we don't care about that extra 1 million sitting as a credit because we're not doing the receivables method. All we're going to do when we do an adjustment is do the 12.5% of 80 million, which gives us 10 million. Remember, when we're dealing with the receivables method, we care about the credit or the debit in the allowance for uncollectible accounts. Okay? Now, using the percentage of receivables, we know how that affects the income statement. The bad debt expense will be based on that balance in our allowance for uncollectibles. However, when we deal with the credit sales method, we see you see how that 1 million affects the balance sheet effect. We keep that 1 million credit in there, and we have a 10 million adjustment, which gives us an allowance now sitting in there of 11 million. We don't worry about whatever credit or debit is sitting in the allowance for the uncollectible account when we do that. Okay, guys, I've just got to put you on hold for 2 minutes. Okay, sorry about that. Okay, guys, let's look at this problem. On December 31st, before adjusting entries, a company reports the following balances. Accounts receivable, $100,000. Allowance for uncollectible accounts, a $2,000 credit, and credit sales of $500,000. The company estimates bad debts to be 4% of credit sales. The adjusting entry would include A, a debit to bad debt expense of $18,000. B, a credit to allowance for uncollectible accounts, $24,000. C, a credit to allowance for uncollectible accounts of $22,000. Or D, a debit to bad debt expense of $20,000. What do you guys think? Awesome. Okay, let's go through some more of the homework. Number 17 here is on April 15th. Sampson Consulting provides services to a customer for $92,000. To pay for the services, the customer signs a 3-year 9% note. The face amount is due at the end of the 3rd year, while annual interest is due each April 15th. Hint, because the note is accepted during the middle of the month, Sampson plans to recognize 1/2 month of interest revenue in April 2021 and 1/2 month of interest revenue in April of 2024. So we are going to record the acceptance of the note, and this note is for $92,000. So won't we show note receivable for $92,000? And was this for services? Yeah. Service revenue for $92,000. Okay. Now, the next one is record the interest collected on April 15th, 2022 and 2023, and the adjustment for interest revenue on December 31st, 2021, 2022, and 2023. So we know record the adjusting interest for interest receivable as of December 31st, 2021. We know the note is $92,000. It was taken out April 15th. And we know the interest rate was 9%. So what I like to do, the note is $92,000. It's at a 9% interest rate. Okay. So we know we want 92,000 times a 9% interest rate gives us the interest for the entire year. This would be an entire year, but that's not what happened. We took the note out April 15th. So we had 8.5 months, right? 8.5 months of interest. So we will show the full amount, divide that by 12 months, which gives us $690 a month. We would take our month times 8.5 months to give us the interest that we would show as a receivable at the end of 2021, $58.65. So we would show interest receivable of 58.65, and we should record interest revenue of 58.65. Make sure I'm not screwing anything up. Then, okay, our next thing would be to record the receipt of annual interest as of April 15th, 2022. So we would show our cash. We would need to show a credit to interest receivable from the amount that was accrued at the end of the year. And then we would want to show our interest revenue for 3.5 months of 2022. So we know 8280 would be the full year. 8280 is the full year. And the amount that we accrued, 58.65, was the interest receivable. And the difference, or I should say, the 690 times 3.5 months should be 2415. Did that work? Yes. So basically what we're doing here is we are recording the interest that was collected after a year, and that amount that was collected was shown as a receivable at the end of December for that amount through 2021. And then from January through April 15th of 2022, we would record the 2415. Okay. Now, the next thing we would do is the same thing. We would show our interest receivable and our interest revenue. And it would be that same amount of 58.65. Interest receivable, interest revenue. And this is interest receivable, 58.65. Then we would show again receipt of the annual interest would be our cash of 8280. We would have interest receivable and sorry guys, interest receivable 58.65. And our interest revenue for the for the 3.5 months would be $24.15. Okay. Then again, the interest receivable at the end of the period and the interest revenue was the $58.15. Then record the entire cash collection. We're going to have cash. We're going to have the note receivable of the $92,000. We're going to have the interest receivable of the $58.15. And we're going to have our interest revenue for those 3 months, which should be $24.15. Interest revenue. And I don't want interest expense. I want interest receivable. See how I screw that up? And this was note receivable. So all of those should total our cash. Of 100,280. What did I screw up? Interest receivable, interest revenue. Why is that wrong? Oh, 58.65. I had my numbers wrong, guys. Sorry. 58.65. Did I screw that up? Oh, I'm just reading it wrong. So then my cash would be off if I mess that up. 58.65. $8.65. Maybe that wasn't messed up because I grabbed it. I just put the amounts in wrong. Does this make sense, what I'm showing you? I hope that helps you. Okay, guys. So we have pretty much covered chapter 5. The biggest challenge with chapter 5 is to recognize when you adjust or when you are determining the bad debt expense and the allowance for uncollectibles in the second, third, fourth year, you must take into account the credit that is already shown in the allowance for uncollectibles and adjust it accordingly. Your bad debt expense and your allowance journal entry will be a plug-in figure. Make sure you remember that. Guys, it's been a delight. Take care. I'm going to stop the recording now.